If you think the Federal Reserve has run out of the money printing tricks that it has hiding up its sleeves, you ain't seen nothing yet. With the Federal Reserve's balance sheet being in decline since April of 2022, you'd be forgiven for thinking that it would only be a matter of time before we would need to see the Federal Reserve step back in, inject some liquidity by firing up QE, quantitative easing, yet again. And in fact, we have already started to see signs of liquidity drying up, cracks appearing in the financial system, with the secured overnight funding rate recently spiking to an all-time high. But the fact that inflation is still here, well above the Federal Reserve's target, means that they're gonna have trouble returning to quantitative easing, at least in the way they've done it before. This is because their job given to them by Congress includes stable prices. Restarting QE would simply add fuel to the inflation fire. But you might be surprised to learn, or not, that there are actually 3 ways that we can get all of the effects of quantitative easing without the Fed's balance sheet even growing. This is secret, invisible, stealth QE, injecting fresh liquidity into the financial system without the Fed's credibility ever having to be challenged, and with policymakers never knowing the difference. We're gonna do a deep dive on each. Here are the 3 methods. Number 1, Treasury buybacks. Number 2, rule changes for bank leverage ratios. And number 3, something I'm calling the balance sheet composition shuffle. And you're gonna wanna stick around for that last one because this is something they've been doing the entire time. So the first method of stealth QE is called a Treasury buyback, and it's something the United States government has already recently begun. So what is a Treasury buyback? Well, you know what a Treasury is. It's when the US government borrows money. And so logically, a Treasury buyback would mean that they pay off that debt early. Now, you might think that's crazy considering that the deficit is currently running at $1.2 trillion this fiscal year to date, which is up 3% compared to last year. So how in the world could they be paying off old debt before it matures? Meanwhile, they're still spending so much that they can't even just spend the tax money. They have to keep on borrowing more. That means they're borrowing more just to pay off old debt early. What is going on? And that's a good question to ask, because if you were to do something like this, it would be like putting extra mortgage payments on your credit card. That would make absolutely no sense. You're taking on higher interest debt that's due in a month instead of in 28, 30 years just to slightly reduce the principal. Doesn't make any sense until you understand it's not about the debt and it's not about government fiscal situation. This is about the financial system's liquidity. Now you can go on the US Treasury's website, treasurydirect.gov, and you can see the details of the Treasury buybacks. Back in May, they issued a press release announcing their plans, and they even released a schedule of the Treasury buyback operations that are currently planned. But just like in the individual example of using a credit card to pay off mortgage payments, that's what's going on here. The US government is borrowing extra money at the shortest end of the curve, meaning debt that matures in well under 1 year. The reason for this is because there's plenty of demand for it. Right now, both institutions and individuals have a huge appetite for debt that matures in a very short amount of time, meaning it's highly liquid, and it pays a very high interest rate. There's a good amount of demand for that. So the government's taking advantage of that by issuing extra debt at that really short-term maturity schedule. And then they're using that extra money to buy back or pay off some of those older, longer-term treasuries. This is allowing banks to offload just a little bit of that debt off of their balance sheets, allowing them to exchange that less liquid, bad debt for some of the new debt that's higher interest rate, a little bit more liquid, makes it easier for the financial system. This is a liquidity injection. Is it a short-term Band-Aid? Absolutely. Are they doing it? Yes. Is it meaningful? Well, it's meaningful, but it's not huge. The key here, though, is that they're doing it and the amount could change at any time that it's needed. And while the amount is currently small, this does count as stealth QE. On to number 2. This is the leverage rule change for banks. Former Federal Reserve insider Joseph Wang wrote a fantastic write-up on this exact thing happening a few months ago. But basically, the amount of treasuries that banks can hold on their balance sheet is governed strictly by rules imposed on the banks, meaning that banks have to look at their assets and their liabilities, and they cannot buy past a certain level of US Treasuries. And with one simple rule change, the Federal Reserve could just say, well, you no longer have to count treasuries into that total calculation, meaning you can have an unlimited amount of treasuries and they won't increase your total risk from a regulatory standpoint. And given the fact that all loans are made with newly printed dollars, in other words, all dollars are loaned into existence, this would turn the banks into a money printing machine specifically for the United States government. They could print as much money as they wanted as long as it was being used to make loans to the US government by buying US Treasuries. And if you're thinking, well, just that rule change alone wouldn't cause the banks to do this because they would still have to worry about losses, don't worry, they've already thought of that. The Federal Reserve already has facilities. They've already tested out the Bank Term Funding Program, the BTFP, when Silicon Valley Bank collapsed, and that allows banks to offload treasuries to the Fed in times of distress. They could resurrect that at any point. They have the discount window, they have the repo facility, they have all sorts of tools that allow banks to go to the Fed to either temporarily or sometimes even permanently offload treasuries that are at a loss if they need the cash. And so with one simple rule change, the Federal Reserve could allow banks to become the money printers themselves, allow them to do QE themselves so that they can loan money into existence specifically to the US government by buying as many treasuries as they want. And they get all of the upside, meaning all that extra interest the government is paying them, with none of the risk. Because if those treasuries ever collapse in value from any external circumstances, the world dumping US treasuries or interest rates suddenly spiking, they don't have to worry about it because if they're in trouble and they need to sell those treasuries, they can sell them to the Fed at full price, either temporarily or permanently. Now, this rule change would be the biggest stealth QE. It would essentially turn the banks into tools of the government, even more so than they already are. And thankfully, this is not happening yet, but it's definitely worth keeping an eye on. And the third tool for stealth QE, allowing the Federal Reserve to inject liquidity into the financial system without their balance sheet actually growing, has been happening under our noses this entire time. I'm calling it the balance sheet composition shuffle. You're gonna see why. Take a look with me at this chart. You'll notice that the shape of the chart looks very similar, very familiar. And that is because it is a chart of the Federal Reserve's balance sheet. Only we have a couple of differences. Number one, this balance sheet is not showing their ownership of mortgage-backed securities. We are only looking at the amount of treasuries they have. We are also seeing a breakdown of the types of treasuries in terms of their date to maturity. Now, if we zoom in here on this section, everything that has happened since 2020, you'll notice a couple of things. Number one, obviously you'll notice the big increase in treasuries that the Federal Reserve owns that they bought after COVID. But another really interesting thing is that you'll see some of the treasuries they started selling in April of 2022, like especially this orange section, which is treasuries that mature in between 1 and 5 years. However, you'll notice this yellow section here, which is treasuries that mature in 10 years or longer, has actually continued to grow this entire time. Yes, that's right. Even though the Federal Reserve has been shrinking their balance sheet, on net, their balance sheet is smaller than it was before. They've been selling more of certain types of securities so that they have extra cash available to reinvest and buy more of other types of securities. In this case, they've been selling extra midterm maturity US Treasuries, and they've been using that to buy even more long-term treasuries. So yes, the Federal Reserve has been engaging in quantitative tightening, allowing the total size of their balance sheet to shrink. However, if you look just at the long-term treasuries the Federal Reserve owns, they have not shrunk that part of their balance sheet at all. In fact, it has still grown. We can see this a little bit more clearly if we take a look at this in terms of the change in their balance sheet rather than the absolute dollar amount. We can see this big spike when they were purchasing a bunch of treasuries, trillions and trillions of dollars worth of newly printed money going into the financial system. And then we can see the change when they started selling. But again, if we zoom in on everything that has been happening for the past 2 years or so, we can see that everything above the zero line is still being purchased, meaning the Federal Reserve is still purchasing on net, growing the size of their balance sheet specifically for long-term treasuries. Yes, on net, they've been selling everything else. the midterm ones, maturing in between 1 to 10 years. They've been selling. But the longer term treasuries, they've still been buying even more than they had before. Now, the reason they've been doing this is the exact same reason that I specified for the US Treasury doing buybacks. This is a liquidity issue. These are the treasuries banks have problems with. These are the treasuries that are underwater the most, that banks have the most liquidity issues with, that they need to try and get off their balance sheet. There's very little demand for these. In fact, every time the government tries to do an auction for these longer term treasuries, the 10, the 20, the 30-year treasuries, they go terribly. There's very little demand for these left. There's a lot of demand for the short-term ones that have the higher interest rates. There's no demand left for these longer-term ones. But the Fed is supposed to be tightening. They're supposed to be selling assets off their balance sheet. So in order to accomplish both at the same time, to try and act like they're fighting inflation while at the same time providing liquidity for the banks, they are selling more of the shorter-term ones and using that extra cash to buy more of the longer-term ones. This is injecting liquidity even while they're trying to maintain that they are sucking liquidity out of the markets. Now, stealth QE moves like the Treasury buybacks and the balance sheet composition shuffle, these are temporary. They're like Band-Aids. They provide a little bit of relief right now, but over the long term, they don't provide any real solution. However, changing the rules so that banks can buy an unlimited number of US treasuries and become the lender to the US government without worrying about limits, risk, all the upside, none of the downside, that would be a solution, as long as you define solution as good for the government, allowing them to siphon resources and wealth away from the economy through the power of the money printer and inflation. This is all just greasing the line to keep government bloat growing. So what happens next? Well, number one, eventually these Band-Aids stop working. Yes, the US government is doing treasury buybacks. That's a temporary fix. It won't last long. Unless they were to run a budget surplus, they can't really make a huge dent. The step after that, if they truly want to engage in stealth QE, would be to change the rules for the banks. Who knows though? They may not want to go that last step with stealth QE. They may just return to quantitative easing. In other words, money printing, debt monetization, like they've done before. Either way, what we are seeing on display here is the classic signs of this phase of the long-term debt cycle, very similar to what we saw 1940 through 1980. Step one, print money like they did in 2020 and 21. Step two, loan that money to the government. Step three, the government spends that money. Because it's done through debt, they eventually have to pay it back. Number four, all that newly spent, newly printed money government spends drives up prices. Number five, the inflation drives up interest rates. Number six, the government's borrowing costs go up as a result. Number seven, which means they have to go back to the money printer in order to afford the spending. This is the process of this phase of the cycle, and we're only about 4.5 years, 5 years into a multi-decade cycle here, which means yes, there will be ups and downs, but the overall direction is higher prices and higher rates for longer. And if you want me to help you learn how to implement ideas like this into your investing, I've just launched a brand new free newsletter called Letters from a Heretic. I'm kicking it off with a 5-part series I'm calling the 5 most dangerous ideas in America. And there I do deep dives on ideas like this so that I can help you implement these strategies and tactics to protect your portfolio, your investing from any economic crisis, whether seen or unseen. As always, thank you so much for watching. Have a great day.